It. Well, welcome everybody. I'm gonna get my share going here. Uh, so we've got like way too much content again, Scott, but we're gonna
It's
do our
okay.
best to get through it. And the point here is to give you an overview of what we're up to, and what we're trying to get done with all of this. So the most important thing, Scott, I think that everyone should come away with is that there's a difference between building revenue and profit and building value in the organization. Is that a good summary of the entire presentation?
100% true. Yes.
And what we're going to do today is help you understand it enough so that you can make a plan for yourself, and also start including that in how you think about serving your clients. And we'll get into some more specifics on that as we go through. So we're going to cover when does a business become a valuable asset? That's the real key, right, Scott? Because most people have an illiquid asset in their portfolio that is their business, and most entrepreneurs, it's like 80% of their holdings, right?
80% to 80 to 90% actually tends to have their personal wealth tends to be tied up in their business. So
And then how do you predict that value? We're going to go into great specifics on this, so you and give you some tools to go think about that. And then really the key is once you know what it is, you're probably going to want to increase value. So first off, we both come from a firm called Impact Architects, the growth advisory firm. We've worked with hundreds and hundreds of clients, 300 plus. I stopped counting, Scott. I don't know. But we work with a lot of companies. We help them typically install a set of tools that we generally call an operating system. We work with leadership teams. Sometimes we counsel one-to-one with executives on how to get to where they want to go. Because the reality is, Scott, almost everyone starts a business as a subject matter expert, but they don't really know the intricacies of wrapping a business around it that becomes a valuable asset. Is that a fair statement?
100% fair. And really knowing the difference, like you said a moment ago, about the difference between driving your sales and profit versus driving your value and
Yeah.
having a plan to drive your value is just great strategy.
100%. So we'll dig into it. So I'm Jim Havland. I'm a lifelong entrepreneur. I come from multiple generations of entrepreneurs. Uh, um, they didn't call them side hustles back when we got started, but I've actually led or been part of the leadership team for 14 entrepreneurial efforts and counting. I've coached lots and lots of teams, over 100 teams in almost every vertical you can imagine, and including some great successes and some people that really struggled, and then really applied that to how I help my clients. About a year ago, I started, really working seriously on exit planning, because what I recognize with my clients is the great tragedy of spending your life building a business only to discover that it's not going to be worth anything when you exit. You're gonna exit. You're gonna leave vertically or horizontally. Someday it's over, and more than likely you've got people in your family or around you that have an expectation that that business is worth something, and maybe you do too. You'd like to stop working someday, maybe. And discovering that's why I went and got my SEPA certification, a certified exit planning advisor. Scott, you want to take it from there?
Sure. So I've been out of let's say corporate and entrepreneurial ventures my entire career. My MBA from Babson's in entrepreneurship. People always say, well, you have an MBA in entrepreneurship, what do they teach you? And I'm like, the golden rule, which as accountants you'll all understand, is happiness is positive cash flow,
There you
right?
go.
Both for your business and personal.
Right.
So anyhow, this entire methodology and structure of the way our business operates is helping owners understand how to maximize the value of their business and put plans to execute the things that are most important to maximize the value of that business in place, so that when it comes time to exit, whether it's in the near future, 3 to 5 years out, or even on a longer term basis, all the work you've done really grows a transferable asset at its maximum value. And we're going to talk today about how to do that and what that really means in the next step for you guys.
Perfect. Thanks, man. So, so that's enough. That's enough of an introduction. So let's go into where is the value. So I like this model because it helps people understand. This is something we developed at Impact Architects. It's been adopted by other business coaches and 90 OS as a way of thinking about businesses. But every business goes through these unavoidable stages of growth. We started off and we're trying to survive. We're trying to make cash flow work. We're trying to make payroll. We're trying to figure out exactly what what our niche is, and then we get to a place where maybe we're sustainable. We're making profit, but eventually we hopefully we get to a place where we're scaling, where we have a chance to scale our business, and once again, going to the end, Scott, scaling is about where your business becomes a valuable asset, where it becomes a company, where you can walk away from it and it's still going to keep operating. Um, and this is, when you think about it in terms of, there's lots of other ways of looking at like the world of businesses. What is it? 75% of businesses are below that mark, right? Right, Scott, is something like that. I was trying to find the number today that are not quite to the place where they can actually exit.
And as we'll discuss a little later, each one of these stages is correlated to a different risk profile, a different
Right.
type of multiple on what all these things impact the value of the business based on where you are. And moving through these stages allow you to increase the value of your business. So having that thought process in mind of how do I get from this stage to this? And these are all common ceilings that people hit in between each one of these structures. And we've
That's right.
just seen it over and over again in our practice. It's, you think it might be, completely unique to you. Sometimes it is, but most of the time it's the same thing that shows up for each entrepreneur as they hit that ceiling. And preparing for that, moving through it and continuing to grow the value of your business is what's important.
100%, Scott. And the thing about it is we know what these steps look like. We
Yep.
don't have to reinvent the wheel. We can guide you through moving up this ladder. It's based on the hierarchy of needs. And ultimately, we'd love to get everyone to self-actualization. It's not going to happen. It's very, very rare. That's why it's a triangle. Uh, but we know that the effort we put into it is all about realizing that I don't know how to do this automatically. I'm not going to be able to do this without some additional education and some different and some growth. But getting to it, there is a place where we can get you to where you can really realize the value of the asset you've spent your life building. And that's what the rest of our presentation is all about.
That's right. And if I can just interject, Jim, so many
Sure.
times what happens is we create these businesses and they get going and we end up stuck in our businesses and we hit these ceilings and it's just, maybe you can relate to it. You're just working harder and harder, but you're not getting any further along the path. And it just becomes really consuming and frustrating. And that's where we can really be advocates to say, hey, listen, other people have been there, done that. This
Yes.
is the handful of things you need to do to bust through that and kind of unlock yourself from your business. And in doing that, you really will enhance the value of your business too. Thank you.
Yeah, of course. Yeah, so the key here, I mean, I wanted to start differentiating because some of you might be really happy where you are. You're not frustrated, but the reality is there is a place to go. There's another step to make to get to the place where, if you're here, it's because you're interested in understanding the value of your business and probably from the standpoint of being able to transfer it at some point. And we're going to cover both those things, but the value builders versus typical owners, there's a handful of things that are important here because understanding what the value is that we're going to help you with today. Durable competitive advantage. That's a hard one necessarily for y'all, but it works. People have done it. People have done built a moat around their product offering so that they are very good at what they do, and that other people can't really offer the same thing. You've got you don't have customer concentration. The company can still thrive even when you're gone. That's probably the one that breaks the back of a lot of organizations because they just used to being the hero. And we get a dopamine feed when we solve problems for people, right, Scott? I mean, if you're the hero every day, that might feel good, but it doesn't actually create a transferable asset as we go through. So let's get into the next step here. Um, this is the simple equation for figuring out your valuation. It's going to be either sales or profit, EBITDA, we'd like to use. You all know what that means, I'm sure. And a multiple that gets you to your valuation. Some multiple of your EBITDA is what your business is worth. And we look at these things. I mean, obviously, all of you can figure out what your sales are, your revenues are, and what your EBITDA are. But we look at it, like I say, it's our EBITDA. That would be revised EBITDA because there's certain things that you do as a business owner that you probably the business isn't going to do once you're gone, right, Scott? I mean, that's one of the reasons we have businesses. We load things up. We paying people's cars. We're maybe paying for education to people. Uh, we are We make decisions that we wouldn't make if we were someone from the outside coming in and running that business. Did you have
Right.
any of that going on in your businesses, Scott?
Yeah, 100%. And as the slide indicates, those things on the left-hand side are all under your control. These are the things that you can make a decision on that control that, which is why sometimes people really gravitate towards these things because they feel more tangible. And the add backs, there's also take backs. Like if you're handling three jobs and the new owner is going to be able to do one of those jobs and has to hire someone to do the other two, they have to add that cost back into what they're thinking. So all of these factors really both positively and negatively impact that revised EBITDA. And as accountants, you guys know all that.
Well,
Um,
and this is something that as accountants, I mean, one of the reasons we're so excited about our partnership with NSA, we would normally bring in an accountant to help someone work through that. Like we would work with our clients' accountants to go through the books and really mark things as whether it's actually going to be the is this part of revised EBITDA or is this going to be something that doesn't cross the border there. And then the
and
multiple, that's oh, I'm sorry, Scott, go ahead.
no, no, go ahead, go ahead.
The multiple, that is something you could only partly control, but we're going to talk a lot about the things you can do within controlling that. I mean, the market is the market. The market in, what's something worth? What people are willing to pay for it right now. That's just the way it is. But you're going to be somewhere on a continuum of best in class. So from worst in class to best in class, you're somewhere on that continuum that whether you're going to get the best multiple there is available out there or something less than that. And that's the part we're going to spend a good bit of time today talking about is how to predict that and get to it.
And I was just going to say before you change that,
Yeah.
one of the things you have on here is the private market capital conditions. That's really where this
Yeah.
outsider perspective, having databases, understanding what deal flows are going in within SIC codes and other types of
Right.
statistical relevant data. It's what that multiple is for your situation, for your client's situation. That's really where the outside perspective can be, the generalization. People go, oh, it's 3 to 5 or it's 4 to 6.
Right.
No, it's really specific based on the SIC codes and the deals that are happening out there
Right.
right now. So that
Right.
that's a fundamental piece of this equation.
And
So
we are going to give you a tool to go figure that out
yeah,
here in a moment.
exactly,
So,
exactly.
so just another visual on it. I want to make it pretty clear. So, when you're working with folks, I'm going way ahead. So, when you're working with your folks, they probably have out of the accounting system, they can figure out what their tangible assets are in the business. You've helped them figure that out. You give them, reports that show them what their tangible assets are. Maybe even for yourself, what are our tangible assets coming from a financial statements? Even though most of your clients probably don't do a great job of understanding your financial statements. Another topic for another day. But most of your valuation is going to come from these intangibles. That's why we spend so much time talking about it because we sometimes don't do a good job of auditing ourselves as to whether or not we are building value in those areas as well. Human capital, customer capital, structural capital, and social capital. Those are the bits, and that's where you're going to have the 3+ multiple on top of it. Just if you just had to close down shop and had to, sell your business today, without any of that, your assets probably aren't that worth that much. I know my business wouldn't be worth that much because my computer is old, or I've got a couple monitors. What about you, Scott? You got any big assets as part of your
I
consulting
am
business?
not. I'm no, not asset driven in my business. So
Right. So the uptick is really in that. So I'm going to take you. We're going to walk you through this process. It might be a bit of an eye chart the first time you see it, but I want to break it down for you really simply. There's 3 stages that we talk to companies about going through: discover, prepare, and decide. And we're going to talk mostly about the discover and prepare parts today. But there is a decide part. I'm gonna go to the next thing and make it super easy for you to understand what goes on here. We The discover part is all about understanding the gaps. How much do you need to make your business worth for you to be okay? And that's really what we're gonna. And that's a great way to be. We should all understand uh, that question. Like, what is it? What does it take for me to be okay after this business goes away? And then once we know that, there probably is a gap. And almost always, right, Scott? There's a gap. There's some things that we could go work on. So building a plan for how we protect the assets we have and then build transferable value on top of what we've got going on. And that's where a lot of the work happens. Then eventually you want to have an expert team around you to help you with that exit. because it's not something you're going to do it once. There's no reason to get good at this, and that's part of what we do during the prepare stage is help you find all the right people that can help you get to that great exit. Did I
That's
did
right.
I do a good job there, Scott?
Really good job. And I would say that it's really important to know that it's not just about the dollar sell price. There are so many structures and so many different ways. And there's a lot of intangibles that go along with this in terms of what do you want your life to look like? What do you want your legacy to be? Do you set up an
Right,
ESOP with some of the benefits of that? So there's lots of different methodologies to exit
right.
your business that when you get the right team around you and you understand what you want your life to look like after you exit, then you can align what is the best exit strategy for you that helps you maximize the achievement of what you're trying to do with your business. It's not just about selling your business, it's about this whole complex dynamic between
Right.
what's your personal plan when you exit. What's that mean for your personal financial situation? And then what's that business value need to be to pull that all together? I know you're about to get into that, so that's a good segue.
Yeah, that's all right. Well, I think it's a great point. And the reality is, unless you are a certified exit planner, you probably don't know all of the choices you have for how to make an exit happen. So that's one of the things I think it's important. You can only choose amongst the choices you have, and there's more choices than you can possibly imagine for how to think about your exit. And that's like, and that certainly as we get to that, we'll
Right.
spend
And
more
the
time.
time to think about that, Jim, is now not like, we see over and over so many people make the critical mistake of actually waiting too long to sell their business. They get
Yeah,
to
well,
that point where they're not driving the revenue, but the expenses continue to increase. And now you're on you don't have the same growth, you don't have the same profitability. But if you started a couple years ago and put all this in place, you would be in a different position to exit than what a lot of folks end up in. And so, especially for you as accountants, I'm sure a lot of you have just, put your heart and your soul and your lives into your practices and, making sure that we understand what this whole process looks like for you as you start thinking about what does your retirement look like? What's your exit need to look like? This is where this stuff can really help you plan and get out the way you need to.
and Rich, I saw you just raise your hand. If there's a question we can help with, maybe type it in the Q&A. Um, that'd be probably most helpful. All right, so let's break into this. So Discover Gate, that's the first part of the process. There's three of these three sections. The other one, first, understand your gaps. And there are three gaps we typically talk about. Once again, kind of breaking it down to its simplest form. There's a wealth gap, like understanding to what Scott was just talking about. Hey, what do you need to have happen in your world? How much wealth needs to be there? How many resources need to be there for you to live the life you need to afterwards? And as
Right.
accountants, you probably can do a pretty good job on modeling what that looks like. But what's that monthly income that you need to get to? And there's great tools out there for figuring that out. And we take our clients through that when we're helping them, figure out what their gaps are. But we start with the wealth gap. What do you need to be okay?
Right. How
Um,
many of your clients might not even, how many of you guys, based on your businesses, might not even know what that number looks like on an annual basis? I would assume being accountants, you probably know that number, but it's amazing to us how many business owners we run into where they don't really know
they're
how
they're
much
heads
money they
down.
make every
They're
year
building their
because
business.
they've got their expenses built into their companies and things like that. So if they really had to extract from that and understand, well, what do I need to live this lifestyle I want? That's a process for a lot of people to go through that might seem a little surprising.
Yeah,
Whereas in a corporate environment, we're like, I know what my salary is. I'd like to replace that. In this environment, it's radically different.
right, right. Um, well, then we have a profit gap, and this is like part of that. The first part of that equation to getting to your the valuation is understanding how you compare to other companies in similar companies, the comps, in your profitability. Are you running a tight ship? Profitable ship? Are you printing money, or are you behind the grade of other people? And that is without question, that's going to be one of the ways that we think about uh, finding your valuation, finding if someone wants to buy your business. Its attractiveness is always going to be based on, hey, are they a profitable business? And if you haven't cleaned up your books to be able to show that, that's one of those things we're gonna walk you through doing. And ultimately, those two things together outline your profit gap. Once I know how much I really need and I know whether how I'm comparing it against everyone on my profitability, then I can start calculating where what's the value of the business currently, and what do I need to get to have the exit that I'm looking for, right? To have the lifestyle post exit that I'm looking for. Hopefully that makes sense to everybody. That makes sense to you, Scott?
Absolutely. And that profit gap is where we can do a lot of work to help companies understand where they're operating against best in class,
Right.
identify those key opportunities within your profit, within the way you're operating and close that. That's a key piece of what we can do to help increase your overall value of your business.
All right. So we're going to drill in now, next layer down to talk about due diligence. So due diligence is the process for those of you who don't know, I imagine most of you do, is the process that someone's going to go through to figure out really what your business is worth. You might engage someone early on, say, hey, I'm interested in maybe buying your business. Then you might sign a letter that says, "Yeah, we both agree that I'm gonna start looking at stuff, and I'm gonna sign an NDA saying I'm not gonna tell anybody what I find, but now I'm gonna go and look under the covers and see what's really there inside the kimono." Are those all inappropriate now, Scott?
Probably, but that's okay. At the end of
It's
the day, it's what can you prove, right?
right,
You operating best in practice, and can you prove that you are? And we'll come back to
indeed.
that as an aside from something later. But yes,
So as I talked about earlier on, I mean, one of the things that people often miss is these things that in the EPI world, Exit Planning Institute, calls the four intangible capitals. And these are real things of real value that are part of getting you to your valuation. It's part of getting you to your multiple based on where you are in these things. So, because we have an understanding as the capital markets are looking for certain things in each of these categories. Human capital being, like the people that you've hired, the people that you have on site, the people that are doing the work. How strong are they in their jobs? Are they leaders? Are they communicating well? Do they execute well? Customer capital. Do I have a high customer concentration, or do I have and do customers love me? And my NPS scores, my net promoter scores, their customer satisfaction is that high? So when I look at my book of business, is that going to be reliable? Structural capital, do I understand the IP of my business? Do I have process? Have I built the infrastructure of a growing business? And the social capital, this is really about the culture of the business and the culture of business inside the business, and also with its stakeholders around. Because ultimately, people are going to give you a multiple of EBITDA because they can make money on it in the future. It's the net present value, like this idea that I know if I buy this business, I'm going to have this kind of profit next year, the year after that, the year after that, and I'm going to discount that based on the cost of capital, right? Cost of capital pretty high right now, Scott.
that's right. And the more risk that's associated with these four metrics, the more unknown that there are with these four metrics, the lower multiple someone is going to be willing to offer you because of that risk profile.
Right.
So strengthening each one of these intangibles helps you build your multiple. And strengthening them means, can I demonstrate and prove to somebody who wants to buy me that these conditions exist?
Yes.
And understanding something like, I'll just pull customer capital out, right? Not all sales are created equal. A one-time sale versus recurring revenue. There's multiple types of recurring revenue. There's monthly subscriptions. There's contracts. A contract engagement is far more valuable than just a one-time purchase that you're hoping someone comes back and another customer buys next month, right?
Yeah.
So the quality of those revenues, building in programs that build the right type of revenue, are examples of how these intangible capitals can be built so that you can demonstrate you do them, decrease the risk to the new owner, and increase the multiple substantially, and hence enhance the value of your business.
Yeah. I mean,
How the whole theory works together.
during due diligence, anyone who's looking to buy your business is going to talk to your customers, going to talk to your employees, going to talk to your suppliers. I mean, you're going to get the full the full review. It's going to be pretty forensic. Aside from just looking at your books, they're going to talk to all these people, and they're going to make a determination for themselves that whether they think any of these things are at risk. Um, So
And usually the offer number doesn't go up during
that's
due
right.
diligence.
That's right.
So that's where all the risk comes out and where, renegotiations
Yeah,
occur.
that is the strategy almost everyone follows when they're going to buy a business. They start high and then they come back with demonstrable reasons why they need it to be lower. I mean, that's they're doing the math that almost all of these folks, if you're selling to PE or to somebody else or even to your employees, they want to buy it. They're looking to buy something. They don't want to waste their time on due diligence if they don't intend to buy. But they also can't afford to risk the capital on what you said. They have to make sure that they've got a pretty good process for figuring out where the danger is, and they're gonna hedge based on that. All right, so human capital, three parts here. Recruit, what characteristics are you looking for in key employee? Motivate and train. Retain, what are you doing to encourage and show appreciation for current employees and evolve with your current grow as your business does with promotions, room for professional development. Uh, I mean, I think this is like a simplified version of it, Scott, but these are all things that we found that our clients have been soft on. And the reality is these are not soft things. These are hard edge parts of getting to, yeah, you're running a great business and I want to buy it.
Right. And making sure that team's in place because someone's buying the ongoing team to create the revenue and profit,
That's
not
right.
you as the owner, right? In an ideal world, you're able to walk away if that's what you want to do. Some people like to stick around, but you can walk away and this business will continue to perform it that way. And that can be a real challenge
Yeah.
in these types of service businesses. So there's ways and structures that we know that we can help to set that up in your type of environment and industry.
Yeah, and this is the most important one. I think that a lot of, especially smaller businesses, we look at the demographics of the NSA, it's very much like the demographics across all businesses. So you're highly represented by businesses that are smaller. And the smaller businesses are the ones that are less likely to have had founders that have moved on to a management layer and more likely to have them working in the business primarily. So knowing that if once you know that, I have to get to a place where I'm not needed every day. I, I promise you that's one of the most important parts of getting a valuation that you really want that says that it recognizes the work you've done. So you've got to find those people and start promoting them. And once you've done that, that's a great demonstration of I know how to build a business, not just do the business. So, all right, let's get to this next one, Scott. So customer capital. How strong are your relationships with customers? Are your customers' relationships deep, long-term, and contractual? Is your business an integral part of a customer's success? And I think I was talking to an investment banker yesterday, Scott, and she told me about four examples of businesses that once they got in there, they realized customer concentration was you know, super high in the 60s, and that's just like a very risky thing to have one or two customers really be most of the business and therefore all of the capital or all of the profit. And part of this too is not we often talk about finding ways to have subscription basis in your customer base. So like, are there things that people can contract to for in a recurring way? Um, and we see plenty of that in the marketplace where people have changed a service-based offering to something that has recurring revenue portions to it that suggests that people are going to stick around with you and hopefully stick around with you for a long time. What is your recidivism with your service, and what is your renewal rate?
And this is a particularly tricky one, I imagine, for a lot of folks that are listening today because you're the main point person in your practice, and maybe it's you that has the relationship directly with your largest customers, and your ability to set up a scenario where they can be interacting or have that relationship with others within your business that lives outside of you can become mission critical. And there's methodologies for that we walk people through, but that's really, I can see that being something that a lot of people on this call might face.
Yeah, and it's hard. It really is hard, but it is the work to be done. If you're a leader trying to build a business of significance, you have to be able to go through that journey. You have to make sure that there's other people that can serve these clients, so that doesn't become a risky part of your business. Um, Structural capital. Are your company process is documented and transferable? Do you have a strategy for to optimize capital and financial structure? And are your equipment and facilities being utilized efficiently? Gosh, the things I find with this is one, typically SOP, the SOPs are too long, so no one actually follows them, Scott. I see that a lot.
Right. Right.
Um, and they're not documented a way that so that if you're abducted by aliens or win the lottery, that someone knows what to do tomorrow. Um, and that we haven't really thought about, what's it going to look like from someone coming in here? Are you reasonably up to date with, in an accounting business might be, software and support software of various kinds, because I think that makes a difference. Are you doing things that a modern accounting practice would do, or do I have to install all that stuff?
Right. And that becomes your demonstrable ability to transfer these processes to the new owner.
That's right. And
So
and it's part of your IP. I
yep.
mean, I mean, I've worked with um accounting firms that had very specific niches, like one that worked with online e-commerce businesses between $1 and $10 million that are in more than 3 states. That was their niche, which I love because it's very specific, and they knew exactly who to go talk to, who not to, and they're able to build process specifically for people in those circumstances. They're able to have metacognition about what their needs were going to be, so they could offer expertise that not even the customers had. Um, the
Right.
last
But
one being social capital.
also,
Go ahead.
part of that too is making sure that's documented reduces the risk to the new owner because it's documented and provable that that process is in place and
Right.
therefore transferable. Without it, whoever the employee doing that work is, if they decide to leave after this new owner takes over, the new owner, it's really risky for the new owner about that person. So sometimes they get
Yes.
interwoven, which is why this documentation of
The
these core processes is really important.
culture will shift. Some people will leave. That's, everyone that's going to buy your business accepts that that's going to be the case. So they're looking for a way to hedge against the damage that's going to cause. Once again, it's part of how they're going to figure out whether or not they've got enough of what they need to make this work well. All right. And last, social capital. What does your social capital say about your business? Are your employees and potential customers drawn to your company culture? Is your company culture transferable to a new owner? So if it's really all about you, we talk about this in our business operating system practice. Every company has a culture. Until you have an intentional culture, you have an accidental culture. And accidental cultures, Scott, don't really get us to intentional results, do they?
No, and this is really about all those things that you do as a business to recognize your employees, to make sure that everybody understands what the mission is, that people feel good, the local accolades you get in the news. This is where the regional top employer awards all come into place. Like, hey, I'm
Right.
really seen as someone that people want to work for. Those are all things that drive the value of your business. That if you're not participating in those type of awards today, can be the type of thing that hey, if I know I want to exit in the next 2 to 3 years, how do I go start participating in those and then maybe win a couple of those so I can demonstrate that I've got a high social capital and prove,
Yeah. Culture is what happens when no one's watching, and I
yep,
think that's part of why a buyer is going to think this is so important. Is there a strong enough culture that I know that people are going to continue to serve customers in a way that would make the business proud now, or is it really just does the founder is the founder paying attention? No, then we can slack off today. It's not a good model. And so in all of these four things, there are a number of ways that, and we're going to show you a survey you can go to that helps you understand where you are with these things. But what you're going to find is you're on a scale, and then this is the EPI scale. I think the one we're going to show you, is slightly modified from this. But the notion that there's like 1 through 6 or 1 through 10, knowing where you are against your comps, like your comparable companies, where are they? Compared to you, where are you compared to them? And that's going to influence how much of that best in class valuation for your SIC code is available to you. Right. There are going to be some things that you're kind of midland in, and you're going to be like 58%. So the contributing factor of that thing to your valuation is going to be in the in the upper 50s, or are you best in class? You're a premier provider in that area, and so you're going to be have access to more of that multiple availability. And here's the worst part about this, my friends, is that if you are below that 45% mark, there's a good chance you're not going to sell. Scott, how many businesses never sell?
I think 70% of all
Yeah.
businesses that go to market actually end up closing in some type of transaction. So there's only a 30% success rate of those that actually go to market to close. Most that fall on this left, it's they're turning off the lights, the employees go home and they're liquidating, and it's like a garage sale of
If
assets.
you've planned for that, if and you're going to be fine, then amen. But for personally and part of our firm, why we take this stuff so seriously is because we think it's a tragedy that so many businesses, and we know from our experiences that not everybody wants that. They thought they were building a business that had some enduring value, and filling in the gaps is what we're all about. Like, what are those gaps? How we solve those gaps together and get you to the place where you have the thing you wanted to have at the end. Um,
And there's a lot of, if you can just go back to that really quick, there's a
yeah.
lot of detail in our methodology when we talk about
Yes.
helping you plan to grow the value of your business. Just a core concept here is that on this 1 through 6 scale, there is no average, right? You have to
Right.
force yourself to be a 4 above average or a 3 below average. In both of those situations, it means that you're doing something that's provable. You might be doing something really well, but you can't prove that you're doing well. You don't have a documented process. You don't have a thing. And in those cases, it shoves you to a 2. It forces you to a 2 unless you can prove it. So
Yeah.
part of the work we do is helping people understand where are they on this scale? What do they need to do to move from the left side of the scale to the right side of the scale? And then help them assemble the proper documentation that moves them up the scale so that they can prove to a potential new owner that this is how things work here. And we are a 4, or we are a 5, or we are a 6, which helps validate the multiple. So when you get into due diligence, you're not sliding back to the left on the scale.
Yeah. Great. Well, let's one more topic to kind of cover here, and then we're just going to go to questions here with what time we have left. When I'm not going to go into everything that we do here, but we do have a sense of these 5 stages of value maturity. We come up with these models to make things a little bit easier to take on, so you can take it home with you. But we certainly, I want you to understand the identify, protect, and build phases of this. So, because the harvest and manage, that's really about really when you're getting to exit, and that's beyond the scope of today. But I wanted to get you to the place where you can exit. So there's the identify stage where we're figuring out where our gaps are, the protect stage where we're okay, here's where the value lies. We're not going to let that break down. We're going to protect that, and then we're going to start to build new value. And this is going to be part of, if you've got an exit in your future that you wanted to talk about, you should take on some initiative every 90 days, every quarter. You've got something you need to do to build and fix the business to get to that place. Um, and so I'm going to look for you to put in on these identify stage. So annual score and understand the value of intangible capitals, right? So this is like every other part of your that you look at your business. You're looking at your financials, but you should look at your intangibles as well, right, Scott?
And when we say score, what we mean is looking at it on that scale of 1 to 6. Where are you?
Yeah.
You best in class and can demonstrate it and prove it, or are you further left?
Um, and then based on that, understanding where your business sits on the range of value. So, where am I now against where I need to be? And we're going to give you some tools here and give you some processes to help get here in just a second. But like that's should be part of you assessing your year every year. Am I making progress towards where I want to be when it's time to exit? You have to understand your gaps, and you understand your company compares to the other companies in your industry. This is a general statement. So, what are the other folks doing? Then, and what kind of profitability are people going to be looking for? Because I just know I need to clean up my books by the time I start getting diligence happening. I need to be able to demonstrate that I'm also profitable.
That's right.
And then your real number versus your tax number. So I think, this is what, Scott was talking about earlier, where you're just going through your all your expenses. And is this one that will endure into after we transfer this asset, or are the things I need to add back because, I'm doing 12 jobs right now, and that's not an expectation I should have for anybody else. No one's going to be able to replace me for what I work for, because part of what I'm working for is the value of the business.
Right. Or are you paying yourself $400,000 a year, and a typical employee doing what
Right.
you do would make 180, and therefore you can add back that difference because the new owner could employ somebody at that lower level.
Yeah, and the last thing on this list is just that, the where are you in your readiness to exit? And we haven't talked about it a lot today, but it's really, what will you be when you're not here? Are you someone that describe yourself as uh, I'm a business owner, or you say something, I own a business? And the difference between those is like, do I own this business? That means I can sell it, or if I am a business owner, that's my identity, and that's hard.
And I will say, I could probably talk to you for an hour about what that journey looks like personally
Yes.
to exit your business. But when your business is so entwined in your identity, understanding and having a plan for what your life is going to look like, what your new identity is going to be, helps you move efficiently. And if you're doing this for your clients, helps your clients move efficiently through the exit process. Because the last thing you want to do is spend all the time and money to put your business up for sale or help a client sell their business. And they get to the final stage and they're like, you know what? No, I think I'm going to wait, because they weren't personally prepared to actually exit from a personal standpoint to understand what that
Yeah,
change of life was going to look like.
happens all the time. It's just
It,
very,
it,
very
it
common.
really does. So
Yeah.
understanding that and having a plan for that's super important.
So I wanted to make sure we cover the 5 Ds also, Scott. This is, so we've been talking about planning for an exit, deciding when you want to go. But I think you all know that we don't always get to make these plans. And how do you make the gods laugh? Tell them your plans. So, so death, disability, divorce, distress, disagreement, these are all things that would initiate an exit that you hadn't planned for. So it's why we really encourage people to start doing some of this exit planning early on. It's just part of your life insurance. Is you've got to you if you've got a family or other stakeholders that are depending on you to be building value, then you should start to take care of that, because at any moment you could be out of business. And I've had to encounter all of these, Scott, as a trigger for an exit.
I've experienced a couple of them personally as an exit. I'm not going to tell you which ones, but
All right,
obviously not death. But the
we're still here. Yeah.
but I mean, but that distress one is under discussed, because when we talk about people waiting too long to exit their business, that's where they enter like extreme burnout, extreme mental health issues that it just makes it impossible to grow and run your business effectively. And sometimes that means you just gotta get out for your own sanity. And
Yeah.
disagreement is places where you might have partnerships, and you're at an impasse on what's the right road to go down. Certainly have experienced this where you think you should continue growing, and your business partner says, no, I'm good. And it's how do you work against that too?
I got two of those in my portfolio right now.
Yep.
Someone's at retirement age, the other one's not. So guess which one wants to do something. All right. So in that build stage, that second stage, view the business value from a long-term strategy. Identify the strategic actions to increase significant value. If you're in that stage, if you think you have some time, it's time to start putting the strategy in place to get to that place where you've got an appropriate valuation. And thinking on a regular basis, every quarter, how do I increase cash flow or EBITDA? How do I go through and increase my scores on my human, structural, social, and customer capital? And then you're going to look at that every year. Like, well, how am I doing? But every quarter, you should have another crack at what we call it in EOS and 90OS rocks. You need to have to build a rock. It's like, I'm going to do this thing. It's tremendously important because it's about the value of the business. Every 90 days, I got a new one. I'm gonna go do something. Uh, and then how are we going to drive growth, efficiency, and culture on a regular basis? Um, so this is what we do about it, Scott. Want to help people walk through this?
Yeah, absolutely. So here's what we propose, and this is pricing that's only available to members of NSA. We've broken it down into the what, the so what, and now what to keep it really simple. And this will work for you personally and your practice, or even if you have clients that are thinking about exiting, you can engage with some of these tools to use for your clients too. So what is the what? Basically it's a self-service valuation. You come in, we give you a link to a portal, you answer the survey, you input the information, and it will give you back based on your SIC codes what the estimated valuation of your practice or the business or your client's business is. In addition to that, it also gives you a little tool to show you what, hey, against these, I think there's 8 dimensions. The tool will
Yep.
show you best in class against where you might be based on how you answered the survey. And it gives you kind of like a, hey, here's where you are. And the nice thing about this is that you can do this for your clients, you can do this for yourself, and it kind of tells you where you are on an annual basis. It's good to come back and check that. Because if you're doing it the right way, as we said, like you understand where you are, and now you can plan based on your financial scenarios where you want to go. This will give you that baseline of where you are.
Yeah, and once you sign up for this, you'll start getting. We don't dump it all on you right away, but a set of basically instructional manuals, white papers on how to advance to give you better ideas about how to advance in each of the ways that you may be deficient in that. And ultimately, what we're also trying to do is help you be uh, uh, cognitive of how this works for your clients as well. When your clients are coming to you and they have questions, this isn't rocket science. It's just about being aware of like how these things impact value, because more than likely your clients will want to have some sense of that.
And it's based on a very large national SIC code based statistical model,
Yeah.
the details of which are proprietary to the infrastructure that we use. But if that's all you did, you could come in and just find out, hey, I'm going to answer these questions and find out what my practice is estimated to be worth today. Or if you have a client saying, hey, what do you think my business is worth? You can come in and answer that question on behalf of your client. So we make it really easy. We'll be giving you a link in a moment where you can just go and sign up for that and do that and know where you're at. So that's kind of like the what. Do you want to cover the
Yeah.
next one, Jim?
Yeah, so the so what is when we're going to be involved with you. So we're going to go through that first stage of understanding where you are right now. We're going to help you with the audit and also help you out with the plan. Like, what are we going to do? What's some scenario planning we should do together? So you can get to the place where you have the practice that you want, you have the exit that you want. And so you still we work with you on the valuation tool. We'll make sure that it's in good shape, and then we'll then we'll work with you on a number of sessions to come up with that planning that you need.
Right. So the so what is kind of a workshop based thing where we do it a little bit more turnkey with you. So we'll take the what, you get that surf, you get the valuation number, and then we'll spend more time walking through like what are those value drivers that are specific to you? Where are those, as we talked about profit gaps, right? Where are those gaps between you and best practices? And start to explain some of that so you can start to put some thoughts into your place about where you need to go.
Yeah, I mean, and we can actually model out if you made certain changes, what would that do to your evaluation, and that's the great part about that one. And
That's
then if you're and here's the thing, folks, if you're way out, the watt's a great one for you to look at annually. If you're 3 to 5 years out, you probably want to get a little bit more active with this. Find some expertise like us to help you, start walking through this and coming up with a plan. But then if you're less than 3 years out, it's time to get active with this stuff. It takes about that long if you want to change the outcome of what's going to happen without it becoming your full-time job. Now's the time, and that's where we have the exit preparedness engagement.
That's right. And that's really walking you through the whole personal plan, working with you and understanding with your personal financial planner what your personal financial plans look like. What are those wealth gaps? What do you need to be able to exit? Understanding what we call the trigger point, the triggering event. If you need $10 million in the bank and you got 2 million in investable assets today, you need your business to be worth 8 million. So when you exit, you got the 10 million you need to create the life you want. So what's your business worth now? And then how do you build it to be that value? And this is all the tools when we work in that now what section with you. We really understand here, if we maximize the value of your business, what would that look like? And then help you bring the right team and plan together to do that.
Yeah. And so there is the QR code here you can follow. This takes you to the site, the FirstOS site, where we have a course set up for this. It's there's a free course, the NSA intro course covers all of this and all the other services that we currently offer to the NSA members at discounted prices. And then also it will link you to if you wanted to do either the first two of those services, they're directly there. And if you want to talk about a full engagement, let's just you can reach out to us directly, and we're happy to make that.
So I'll just show you, if you go through that, you'll see a section in there under the FirstOS page that says number 3, exit planning.
Yeah, there you go.
It's your exit planning resources specifically, and you'll see that tool. So and if you have any problems, you feel free to reach out to either Jim or I. Our emails are readily available. Find us on LinkedIn, whatever way. We will happily walk you through getting to exactly which one of those 3 you need. It's never a problem for us.
All right. So Scott, we've managed to scare away a fair bit of our audience with all of this. Is there anyone that has questions that we can answer today? We are going to be coming up with a very highly structured way for you to be doing this with your clients when you actually become an affiliate. That's not ready for yet, but that'll come next. And aside from that, we're
Really?
okay. So Dave, I see your question here. What is the multiplier? Uh, the the range that I've seen, unfortunately, is 1 to 4, and unless you've got a very specialized niche. We have been making arrangements with a large aggregator of small accounting practices that will pay even more based on your location and what kind of customers you have. So we're trying to put together a package like that so that when we identify people, we can give you a path to that. But that's what I've seen, Scott. Is that hit with you?
Yeah, you know what? I was trying to think of the last time I ran the model on the account. I can't. It's a great question. I'm sorry, I should have prepared and had that answer. I don't have that answer right in front of me.
Yeah. We'll include that in the free
In the
course.
future, yeah.
Yeah, I mean it's something it's knowable for sure, but unfortunately it changes, and I think I haven't done a transaction in this space in the last 9 months, and I don't know if you noticed a lot of change in the market in the last 9 months,
Yeah.
Scott. Uh, but thanks for that.
I was just meeting with some investment bankers from a very, very large international bank, and they were saying all their databases are going through a lot of restructuring thanks to AI. So they're
Yeah.
actually getting really incredibly optimized and contemporary on their information. So
Yeah, that's great. Yeah, I mean, because the model that you're going to be going through is a bit like Zillow. Um, it's based on you can still be hidden stuff. That's why we ask all of the intangible asset questions because that's really where things get down to. Oh, we didn't
right.
really talk about the 90
I,
software. So in the if we're going to work with you in a longer term engagement, we will give you 90 software. 90 is a business operating system software, and it allows us to start baking in all the things we're working together on to build those rocks, to execute those workshops and those meetings we have together in a highly structured way. We put all of our clients on it, for business operating system clients. It is phenomenal software. 20,000 companies are using it every day to work on the business, not just in the business. So that's great. Um, so Stephen was he's
I
got a
will also say one other thing, Jim, about 90, just to pitch 90 really quick, is that you're part of the process of exiting, as I've been saying, is demonstrating or proving that it's there. One
yes.
of the best things about using a software tool and even using something like 90 within an operating environment, an operating system environment, is that it does a lot of the documentation for you so that someone coming in to look at your business would actually be able to look at the data and the historical data that's captured in 90 for things like your reviews,
It's an
your
automatic data
org
room.
chart.
Yeah.
Yeah, it kind of gives you a data room
Yeah.
that gets maintained as you're simply operating your business. So it's a little bit of work up front to get it going, but then a couple of years later, you've actually got a beautiful data room. So
Yeah, so Marshall asked if we partner with accounting firms and working with the clients and providing exit strategies. Absolutely. Um, Accounting firms are one of our are great referral partners. As they encounter clients that want to do a great job of this. There's this part that you can do, and there's certainly things that we can do, and with all of that, and we're happy to talk about that. And that's the intent of our next part of this, is to give it a financial back portion as well. So there'll be some affiliate type revenues for everybody, as we make those recommendations. And I think Stephen, we should talk. um, I know you've been told that your business is not very marketable. Um, there's a lot of dependencies on that, and there's a lot of different ways of selling it. So if you've talked to brokers, then that's one kind of thing. It's like, that's like the MLS, um, listing for businesses for sale. But taking it through people, that's why we've kind of set up this pipeline for people. We know, we've got private equity connections that would help bundle some smaller firms together, and then prepare them for being sold to a larger firm. We've kind of got that all figured out. So, but if you're in that mode, definitely reach out to us. We'd be happy to help you walk through all of that. Uh, a peer review add to the value. I'm not quite sure what that means, Roy. You know, explain a little bit more. Should we bring Roy in so we can explain with live words?
Sorry, I was muted. I did allow Roy to talk, and I guess well, I mean, if you want me to allow others as well, I totally can.
Okay, yeah, Roy, if you don't mind, tell us tell us a little bit more about what you're asking. Oh, so he's dropped off. All right,
You got shy.
that's all right. That's
No,
okay.
it's okay. I wanted to make sure I understood. Roy Alexander. Okay. I'm going to make a note of that and find out.
What that means, yeah. Well, terrific. Well, thanks everybody. We really appreciate it. Like I said, the easiest way to kind of get into this and to learn more about it is to go to that. I'll put the QR code back up. Go it This course is free. It's got lots of information in it about all the ways we can help. If we start there, it's a great place to start, and then we can direct you to whatever most best fits with where you are and what you want to try to accomplish.
That's right. When you see that intro course, you'll see the FirstOS. And again, it's under section 3 is all the exit planning materials with a link directly to
Yeah,
where you can click to get your valuation for that 249.2.
yeah, yeah. It's a very valuable it's a very valuable tool. So
We,
I highly suggest it, and I think your clients will like it too.
yeah.
Thanks, Roy.
If there are other
Thanks,
questions, or
Stephen.
even as we build out our intention is to come back and continue to do these type of webinars. So if there's other valuation related topics that any of you would be interested in hearing,
Yes.
we'd love to be able to orient a future slide or two on those topics. If there's a facet of this that you either for your practice directly or maybe for some of your clients that you're seeing, we're happy to make sure that this is as valuable as possible.
Yeah, I think I got the idea, Scott, that maybe we do one on the range of exit possibilities. Like, so, um, it's so vast. It was one of the things that I learned by going through certification, was that there's way more things that I didn't even know about, were options for how to structure it. So,
Great.
um,
Well, I see we're at time. I just want to say thank you to everybody. Really
thanks, everybody.
appreciate your attendance, and again, reach out to us. We'll help make sure you get to exactly the right spot, and we will go from there.
Perfect.
Have
Thanks,
a
Scott.
great day, everybody.
Thanks,
Thank you
everyone.
so
Bye
much.
now.